So let's take a look at this financial projection tool and how you can use it to create financial statements. Again, this is just a method to communicate to the readers what are the financial implications of the business opportunity that you're going to pursue. So the first thing to notice is across the bottom we have a variety of tabs, and these tabs we're going to walk through each of them as we move forward. But first let's look up at the top. It gives you a company name, and so you can go ahead and put the name of your company in there. Let's walk through an example using Chad's Coffee Shop. Everyone should be pretty familiar with what a coffee shop is and the products that it offers. The next section says, once a sale is made, what percent of the money do you collect during the following time periods? So in a coffee shop, when a consumer comes in and buys a cup of coffee, I would expect them to pay for it right then and there. So 100% of the time, I'm going to collect my sale at the point of sale. For other businesses and other industries, you may not do that. You may have to bill or invoice your clients and expect them to pay you at later periods of time. And if that's the case, you can adjust the percentage based on when you would expect to calculate or when you would expect to collect that money. The next section breaks down each of the product or service categories that you're going to provide. So the first one here you can adjust. It says product service 1. So let's assume that the primary product that I'm going to sell in my coffee shop is coffee. I know, big assumption here, but so let's assume I'm going to sell a coffee. Now, next one says average price per unit. Now we can get into, many businesses will have a variety of product lines, and so coffee is certainly going to be different from lattes and cappuccinos and tea and a variety of other types of products that you can provide. But the key thing is to try to lump them into similar types of categories. So let's assume that I'm going to sell drip coffee and it's going to be $1.25 per unit. Now I'm going to incur a certain number of material costs in order to produce that cup of coffee. Primarily the beans that are going into making the coffee. Maybe you could calculate the water, but I wouldn't suggest it in a coffee shop at this point. But the cup and the lid and those pieces that go into the material pieces that go into making that cup of coffee for the consumer. And so let's assume that I'm going to incur 15 cents of material cost per cup. Now, labor cost, you would include this here if you pay somebody per unit that you sell. So if you're going to pay an employee um, a percentage of sale, like on a commission basis, or if you're going to pay somebody a certain amount every single time they make a unit for you, well, then you would include labor costs here. Otherwise, we're going to include it somewhere else. And then down here at the bottom, you can see that means my total costs are 15 cents. I'm going to make $1.10 every single time I sell a cup of coffee. And then in year 2 and in year 3, I can adjust these prices and costs to reflect a projected increase. So let's say I think that in year 3, I'm actually going to have to raise my price to $1.30 because I think the price of beans are going to increase. And so therefore, I want to make sure that I increase my price as well. Now over here on the right side, you can see I have units sold. And so for month 1 of the business, let's say I'm going to start in November and then December and January, and you can see you can continue to move through if you'd like. In year 1 of November, how many units of coffee am I going to sell? Obviously, this is a projection and there's no way to get it right. But you can use your market research, you can use your survey and focus groups, you can use comparables to other coffee shops in other parts and other locations in order to justify this number. But the bottom line is you do need to do some research to come to some number to feel comfortable with the number of units you would project to sell. And then you would just put that number in. So let's just assume some random numbers here just for the sake of argument. And then what you can do is for years 2 and years 3, you can either go in and change those individual monthly numbers if you want. So I can say, now I'm going to start with 200 in year 2 in November. Or I can come back and say, all right, I'm just going to have a blanket 10% increase in sales in years 2 and another 15% increase in sales in years 3. And it will automatically change those numbers to reflect that. So you would go through and you have up to 6 product categories that you can include. And so you would come back and you would say, all right, we're going to sell muffins, and maybe I'm going to sell, I don't know, t-shirts along with that. And so you would put in the price per unit, the material cost, any projected increase, as well as the number of units you would project to sell. The next tab is expenses. So in your expense tab, you come back and you look at how much money do you need to actually start up the business and how much are you going to incur on a regular monthly basis. And so in startup capital, you're going to need a certain amount of money to start the business. Again, I refer you back to the funding module where I encourage you to think about starting your business with less money. But certainly there's going to be some type of startup expense that you may incur. So let's say for a coffee shop, I'm going to incur some equipment costs. Let's say I have to buy a coffee roaster. I have no idea what it costs, but I'm going to incur a coffee roaster, and I'm going to have to buy some tables and chairs, and I'm going to have to, put in a counter and paint and, make some improvements to my leased space. And so let's say that that's going to run me another $10,000. So you would go through here. You can change the titles of each of these categories if you want, but project the amount that you're going to need to start the business. The next one is owner's compensation. And so this is the amount that the owner will need every single month or will withdraw from the company in order to make their personal living expenses on. So let's say as a startup, I need $2,000 and I need $2,000 every single month afterwards. Employee salaries, you calculate those hourly or salaried employees. So again, these are the people that you're going to pay. Really, regardless of how many units they sell, you're going to pay them an hourly wage or you're going to pay them a salary. And so let's say you're going to incur $3,000 up front, an additional $3,000 every single month. That's not 30. 3,000 every single month afterwards. I've automatically calculated for you 7.65% for Social Security and Medicare taxes. You can adjust this number based on your current tax rate, based on the applicable taxes that you may incur in your region. So you can just adjust that number and it will automatically calculate for you the taxes that you would incur. The last one is employee benefits, and so you can go ahead and include numbers in here if you're going to pay for additional benefits for your employees. The next section, you have up to 6 categories for product or for business expenses. Again, I know that you're going to have much more than 6 categories of expenses, but I just want you to lump them into similar types of expenses to get a better handle so it doesn't get too unwieldy here. So let's assume you're going to have to pay rent and insurance. Let's assume you're going to have to market, and you're going to have some phone, you're going to pay utilities, a variety of other things, obviously, but let's assume that you're going to have some of those key expenses. And so you may have to pay $2,000 up front for rent and then $1,000 every month after. And insurance, maybe $100 up front and $200 every month after, whatever your numbers are. So you go through and provide those numbers. This also allows you to do a percent increase for years 2 and years 3. So you can say year 2 salary, I'm going to give everybody a 3% increase in salary, and then I'm projecting a 5% increase in business expenses. If my sales are going to increase, then I would expect that I would have to pay more in utilities or marketing or telephone. So those items are likely to increase if you're increasing your sales. And then you could do the same thing if you want for year 3. It automatically assumes a 25% income tax rate. Again, you can adjust that based on your current tax rate effective in your area. The startup capital section says, all right, my total startup capital that I need is $67,483. So where am I going to get that money? So one thing that you can do is it says owner's injection. So you'll want to increase or input the number that you yourself have saved and you are going to invest in the business. So let's say that I have $35,000 that I've saved. I'm going to put that towards the business, which is a total of 51%. And then outside equity investment, so this would be friends, family, angel investors, venture capitalists, anybody else who's going to want equity in the business. You're not going to pay them on a regular monthly basis to return their money. They're going to get a return based on the profits of the business. So outside equity investment, let's say I have another $15,000 that I have from friends and family that are going to put towards the business. It says you have a remaining $17,483 that you need in order to start up the company. So what this does for you, it says, well, the third category that you can look at is a commercial loan. So $17,483 into a commercial loan. This is assuming 6.25% interest, but again, you can adjust it based on your credit history and what your current interest rate might be from your local institution. And then it assumes 60-month payback period, which is 5 years, and maybe yours is going to be different, 36 months, let's say. And then so it automatically calculates for you your principal and interest payment would be $523.97 every single month. So based on collecting information for these expense numbers, again, you just got to go out and find how much rent will cost and find how much marketing you're going to, what that expense is going to be. And based on some projections on the price that you're going to charge, the material costs that you may incur, and the number of units you plan to sell, based on those two things, this will automatically calculate for you a break even. So this says you have to sell $100,915 in order to break even. It automatically calculates a cash flow statement for you, which shows you the amount of cash coming into the business and the amount of cash going out of the business. It automatically calculates for you an income statement, which shows you for years 1, years 2, and years 3 what the net income or net loss would be for your business. And then it automatically calculates for you a balance sheet for years 1, years 2, and years 3. And you can see that the balance sheet balances for each of those years. Finally, you go to ratios and it calculates for you some of the key financial ratios that you may want to consider looking at to see how your business is functioning from a financial perspective. So based on those things, go ahead and take a minute, download that spreadsheet, start looking at it, getting familiar with it, and inputting your expenses and your projections based on your business, and it will calculate your spreadsheet for you. Thanks.